Days Sales and Inventory, or DSI for short, is the number of days it takes a company to sell its inventory. Days Sales and Inventory is calculated by taking 365 and dividing it by the company's inventory turnover, where inventory turnover is calculated by taking the company's cost of goods sold and dividing it by the average inventory balance. And to find the average inventory, just take the beginning inventory balance plus the ending inventory balance and divide by 2. Now, some people use the ending inventory instead of the average inventory balance when calculating DSI. But this isn't a good idea because the ending inventory is the inventory balance as of the last day of the fiscal period, and that might not be representative of the typical inventory balance during the period. Now let's do an example so you can see how to calculate both inventory turnover and days sales and inventory. XYZ Corporation reported cost of goods sold of $100 million for the fiscal year ended December 31st, 2021. The company also reported inventory of $20 million on January 1st, 2021, and inventory of $30 million as of December 31st, 2021. Thus, the average inventory for 2021 was $25 million, and the inventory turnover was 4. This means the company sells through its inventory about 4 times a year. And now that we know the inventory turnover, we can calculate days sales and inventory. We take 365 and divide it by the inventory turnover and find that the DSI is 91.25. Thus, it takes XYZ about 91 days to sell through its inventory. Note that DSI is inversely related to inventory turnover. A low DSI means high inventory turnover, which is good for the company. But a high DSI means low inventory turnover, which is bad for the company. A company wants a low DSI or high inventory turnover because that means it's selling its inventory quickly. The company will have less capital tied up in inventory and lower inventory holding costs. And because inventory is moving so quickly, it's less likely to become obsolete or spoiled, which means fewer inventory write-downs. A high DSI or low inventory turnover means the company is selling inventory slowly or that some inventory isn't selling at all. This means capital will be tied up in inventory for longer, inventory holding costs will be higher, and inventory write-downs will be more likely to occur. And that's it. If you'd like to receive a series of PDF guides like the one I used to create this video, plus an Excel dashboard and a DSI calculator, you can sign up for my email list by clicking on the link in the description section below. You can also become a supporter on Patreon and access the PDF guide and the Excel file today.